TechTrends.net. Today's Saturday, the 19th of February, and we had another ugly week in the market. Semiconductors were actually unchanged, but the rest of the market, pretty much across the board, was down, adding to weakness that we've seen so far this year. We're clearly in a bearish environment for stocks. Don't get focused on labels like bear market. It means nothing. If you just look at the average stock and what they're doing, the devastation out there is just incredible. AFRM down from 175 to $37. Roku got hit really hard again. As that downtrend continues from close to 500 all the way down to 112. I mean, down 79, 80%. Just incredible. The losses here that people continue to buy these dips, and they're not dips. They are downtrends. They are broken stocks. They are garbage for now. If they don't scare you out, they'll typically wear you out, and there's just no advantage to trying to buy in here. The losses are, again, devastating. Facebook, Roblox, this so-called Metaverse thing that's going on, MTTR. These were all the hot names that the Metaverse was going to be this great new area. Pinterest. I mean, the list goes on and on and on. Peloton. Just incredible devastation out there. Don't buy them in downtrends. Don't buy them when they do this too. Peloton had this rumor of a buyout, and then it came right up to the volume weighted average price from this gap lower. It hung out there for 2 or 3 days. Now it's down 25% from that point. There's not going to be a takeout. People don't buy stocks, and stocks like this don't get bought out typically. That's just the way it goes. If it happens, it's an anomaly. The fact is, these are broken stocks. Apple is, holding on, but looks vulnerable. AMD still, it's in a downtrend. There's no point in trying to buy this. It's trying to hang out near this 200-day moving average and last year's volume weighted average price. Amazon, just looks terrible, especially if you look at the weekly chart. This prior big band of support acting as resistance looks very similar to the Russell 2000. Shares of, again, Facebook, even Microsoft, it's done remarkably well. I mean, if you're not locking in profits or don't have an exit strategy, it's your fault that you lose your money. So far, we've seen that last year's volume weighted average price was the exact low for that first bounce, and now it seems as though it's likely to be tested again. So let's go back to the market, because the S&P 500, as we know, found buyers right at that volume weighted average price anchored to the beginning of last year, and we bounced up to the year-to-date volume weighted average price, and we still have a declining 20 and 50-day moving average. That means it's guilty until proven innocent. Don't trust these rally attempts. If you're a short-term trader, of course there's opportunities to buy these, buy into some of these rallies, but don't hold on to them for too long. We're in a bearish environment. Whether it's a bear market or whatever you want to call it is completely irrelevant. The Nasdaq, as we know, the volume weighted average price from the beginning of last year didn't hold the same significance as the S&P 500 did. Instead, it has been, the volume weighted average price off of this August of 2020 high that had been found buyers here, and now we're testing it once again. And that's also the same exact volume weighted average price that we see in the semiconductors that we've discussed previously. Now, back to the Nasdaq, we're right on that volume weighted average price. It doesn't mean that it's going to hold. It's just a level of interest because it's been important in the past and it bounced significantly last time. Now this time, if we get a bounce, what I think is most likely is that we get a little bit of a bounce, perhaps up to last year's volume weighted average price, and then the next leg lower. So we look at these not as areas necessarily to do business, but to look on shorter term time frames to see if the buyers are gaining control. So far the answer, in the Nasdaq is, of course, they're not, because we're below the declining 5-day moving average, and we were all last week. There was absolutely no reason to be a buyer. We were actually above it briefly Wednesday afternoon, but you don't trust rally attempts with a declining 5-day moving average. It's the direction that's more important. And people who bought this so-called breakout, it was already extended from 350 to 356 in a primary downtrend. That's not a recipe for success buying those. By the way, this vertical line is where we were 50 days ago. I like to keep that on my charts just to kind of anticipate the direction of the 50-day moving average. And you can see it's still declining and will be declining unless we're back up above 390, which doesn't make any sense. We're not getting back above 390 anytime soon. To me, it's much more likely that sometime in the coming month to 2-3 months that we come down to the volume weighted average price from the COVID low. That has yet to be tested. I think that's likely. Now, along the way, it's not going to go directly there. I mean, maybe you could say, okay, off of this volume weight, this might be a stopping place, but this remains to me the primary level of interest on the downside and very likely to be obtained in the Nasdaq. That's at about 315. We're at 341 now. That's still 10% lower. Take the risk seriously if you haven't already. The Russell 2000, as we know, did test the volume weighted average price from the COVID low and bounced almost perfectly from that. I mean, if you look at that, that's clearly not a coincidence. That is institutions in there with orders. So now we have the volume weighted average price from the low right here, and we're back below that from the January 24th gap low. We're right on that. And what's the pattern coming into it? Well, we have this high and we have this high. This high is lower than that high. We have this low and we have this low. This low is lower than that one. So what does that mean? Lower highs and lower lows. We're in a downtrend. We're below a declining 5-day moving average. It's more likely that if we get a bounce in here, perhaps up towards that 5-day moving average, the next leg lower brings it back down for at least a test of this. And what we often see is a slight undercut of an important low like that, as people who are up here thinking that it's okay, they're saying, well, I'm going to be long with my stop under here. That makes no sense. Get out now if you were involved in this rally here. Don't wait for it to go all the way negative, because what we often see is a quick move lower, take out those stops, shorts start to cover, and then we get a more significant bounce. Now, it doesn't mean I'm expecting this to be the ultimate low for the Russell 2000. If you look at the Fibonacci retracement, that's only a 38.2% retracement. So what we see when we see a confluence of these indicators come together, such as the volume weighted average price from the low and the 38.2% retracement of that range, well, what we have is supply and demand dynamics that are coming together in the same place for different reasons. In other words, if you were a short seller up in here somewhere and you said, hey, I'm going to start to cover when it gets down to 38.2% retracement, you might be completely unaware that the volume weighted average price from the COVID low was there. And vice versa. The volume weighted average price buyers or short coverers or people who are saying, I'm going to start to average dollar cost average in at that level because it's the volume weighted average price, they might be unaware of the same reason that people are buying in that area, or sorry, a different reason, but buyers in the same area for the Fibonacci retracement and for the volume weighted average price. It makes those levels more powerful. So what I'm thinking is more likely, as I said, maybe a slight rally gets trapped still underneath that year-to-date VWAP, comes down, undercuts this, then a bounce, and then perhaps another leg lower. These sell-offs, they say typically last 6 to 9 months or something like that. I pay no attention to that. I want to just listen to the market, not to statistics. It's good to have an idea of what might happen, but the fact is we're guilty until proven innocent. In the semiconductors, they're in a downtrend. Don't be trying to buy dips in AMD because you like the company. It's had a huge run from 10 to 160 in just 3 years. It's time for a pullback, a deeper pullback, a rest, a pause, whatever you want to call it, but it's not time to be averaging in, unless your time frame is 10 years out. And we have people telling us about their 10-year horizon that don't invest for 10 years. Instead, they puke it out 14 months later. And I'm talking about Palantir. I'm going to do a post on Twitter about that later, so look for that. Anyways, semiconductors are trying to hang on to the volume weighted average price from the beginning of last year. As I mentioned, the more important level is the volume weighted average price off of this high right here. That was it August or September? I don't even know. It doesn't matter. So, September 1st of last year. We see that, 2020. Support, buyers showed up again, almost to the penny that time. It seems highly likely that we come back down and at least test this low. More likely, kind of what I've outlined, a quick undercut, then a rally, get trapped underneath this, and then the next leg lower. Look at the move these semiconductors have had. Look at the volume weighted average price off of the COVID low. That brings it down to 230. That's more than 10% lower. Take risk seriously. It's not too late to sell and lock in some of your gains. Don't get hung up on the fact that you were up 100,000 and now you're only up 70,000, so you're going to wait for it to get back up 100,000 or whatever the numbers are for your personal scenario. Biotechs have been a great example of why we don't buy dips and why we look at guilty until proven innocent. We saw the 50-day moving average trapping sellers, trapping buyers, that is, and then the year-to-date volume weighted average price, that's this pink line, perfect level of resistance. We saw that this broken support, we broke down, rallied up on lighter volume, that next leg lower. It seems highly likely that this week coming up we undercut this low, and again, perhaps we undercut it slightly, experience a little bit of a bounce, people get excited, shorts cover, but then the next leg lower might come. This market just looks terrible still. I wouldn't be surprised to see it down at 115 at some point this year. And financials, they're kind of just, hanging out here in big wide range. I don't see any advantage to getting involved in the financials. They're holding up on a relative basis, but they're not making any absolute progress over the last 6 months. If you look at, where we were, $39, we were back there August of last year. They've done nothing really for the last 6 months. Now, of course, traders are going to have a different opinion, and it depends all on your time frame. But right now in these financials, we're testing the volume weighted average price from the January low. We're trapped below the declining 5-day moving average. If you're looking to buy these, it makes 0 sense to be a buyer while that 5-day moving average is declining. Energy names are still correcting through time, holding really well on that 20-day moving average. That's a strong sign for these, but they're starting to slow down. They're going sideways. I think that if they break below this 67-ish and stay below that for, let's say, a day, if they close below it, maybe they do something like this, then, undercut, test, and then I think that profit taking will most likely spill over to this group as well. Anyways, again, take risks seriously. It's not too late to lock in gains or sell losers because it can get a lot worse.